Hi, today is Monday 13th. It is 10:30 UK, 5:40 New York, and this is the weekly recap for last week. And what we did last week is that we closed January, and so I'm going to go through the February and March trades and then review how we closed January. For the February reg, as you can see, the trade is quite safe. Last week we only did a PCS roll. It was on Friday, just after the open. I probably didn't get the best price because I did it very early. I had to leave my computer. I got about 110 credit for this adjustment. And as you can see, there's virtually no upside risk left to this trade in case the market keeps grinding up. If we look at expiration, we have a maximum potential loss of $90 on the way up. And on the way down, we have sufficient negative delta all the way to about 3150. And I assume that in case of a sudden fall, which is quite unlikely, the T plus zero would sink and we would probably have the delta going neutral to positive around 3185. And if you have watched the SPX Outlook video, there are a number of supports all the way down to 3200 and 3177. So really there's no expected adjustment for the next few days here. And of course, this trade would benefit from going back towards the 10th within the next few weeks. Ideally, the market would retrace to about 3150, 3170. Now, if the market drops abruptly around earnings season in 2, maybe 3 weeks' time, we would then probably take profits on the upper layers that we would shed one after the other. But now that the lowest shorts are on 3,000, this trade has no risk whatsoever on the downside. So nothing to do on this trade for probably the next 2 weeks. The B2B trade, as you know, doesn't have the same flexibility because it doesn't have those upper layers. So to reduce the upside risk, we had to do PCS rolls or reverse Harveys. So this trade is also pretty safe, but it's at the same time it has lost a lot of theta in the process. So this trade will probably go nowhere. Well, this is the end of the sweet spot. So the only thing we can really do is just carry on with that RTT mutation. If I go back to the regular trade here, as you can see, we are in a 10% delta to Vega ratio. So this trade is likely to remain stable, although it is not absolutely paramount to this trade management because there's no upside risk. But in case we would have potential loss on the upside, this 10% ratio almost guarantees that the trade will remain stable if the market would hover in the same area or even go up. The market has opened up this morning at 8 a.m. UK, and now it's hovering around 31.77. And of course, we would be watching whether the strong resistance around 32.85 is being tested or broken later on today. Now, on the March trade, the trade has been scaled into full size on Thursday, and of course, with volatility being low, there's the possibility then to narrow the additional Brocken butterflies to 75.50. I assume that we are reaching a top on 32.85, so I went for the full size 100/70 Brocken butterfly, which obviously costs a little bit more and are adding upside risk because now the upside risk is around 1400, which is still reasonable for this type of trade. When in 2017, when volatility was very low, it was quite common to see an upside risk before any adjustment about $3,000 or up to $4,000. So we still have been able to enter at reasonable price, especially the first batch of Barking butterflies when we entered on the 3rd of January. So this trade is quite safe. It's making a little bit of money. In terms of downside cover, we shouldn't have to worry too much. 67 DT, we still have that natural early resilience of the trade for another 2 weeks. So I would assume that unless the market shoots up, and then we would maybe look at an additional layer. With $14,000 of capital usage, we can definitely do better. Now, we would, of course, need to be in an environment or in circumstances for an upside hedge. We would need to allow the negative delta to build up to around 40, and we are only about 1 minus 12. So in the best case situation, the market would probably be pausing on the strong resistance 32.85 for a while, probably a couple of weeks or 3 weeks, to let delta build up, and at the same time also allow better protection on the downside. The downside protection at the moment, if we look at the negative delta, and of course at this point in time, this trade being resilient, do not anticipate in the event of the market falling the T plus 0 to sink significantly. At the same time, it means that we would probably, as I mentioned on Slack last week, we would probably monitor the lowest short, so 31.50, as a trigger point to either add to the trade or roll back a couple of broken butterflies. So on this trade, just as the B2B trade, which I'm going to show right now, the C150 is the given trigger point for a downside adjustment. So now lastly, maybe let me show you the trade log. So now lastly, the March B2B, which is a simpler trade for beginners. This one has not been scaled in because I entered that one as per rules. So the upper longs are on 32.50, which means that the scaling point is around 32.85, which is a strong resistance that has been briefly hit. And as I said on Friday, I would review on Monday whether it makes sense to scale in, but now the market was at 32.65 at the close. It's hovering below 32.80 right now. So of course, after the open, if the market starts shooting up, I would have to add 2 broken butterflies. And with 32.85 being the trigger point, that means that the broken butterflies that you may want to prepare in advance would be with upper longs on 3300, so it would be 3125, 3225, 3300. So this would be the kind of full scale position. The delta would be around minus 16, minus 17. Unfortunately, pricing now with volatility going down, the pricing may not be very attractive, and I anticipate the price would be probably $5. Actually, it is now quoted 5.45. So this is not exactly a very enticing market to scale in. And at the same time, because volatility is low, VIX in pre-market is at 1263, actually stable to slightly up. But it is fairly low, so we can have the same decision to make between going for a normal size 175 or maybe in the same way as I did for regular, just go, sorry, it would be 2, not 3. This would be the regular add-in. So this would be the regular add-in with capital usage going from 8.3 to 14.400. And if I was to be more conservative, yeah, I would go for the 75/50, and that's what it would be looking like. This one is, we would be flattening delta. So there again, this kind of adjustment or decision to go 175 versus 75/50 does have an impact further down the line on the capacity of the trade to reach a delta alert for an upside hedge. Now, of course, if the market was to retrace, that this trade would be doing fine all the way down to 32.25, 3200. And if the market drops to 31.50, the first thing to do would probably to take off that upside hedge and maybe start rolling down the initial combo. So there's not much to do or to worry about unless, as for this trade at least, unless market breaks 32.85, and on the way down it's the same trigger point around 31.50. Now finally let's have a look at the trade arc close, which is January. January was closed for minus 65 and it was closed on Friday, so let's just move to Friday. So this was the remaining combo just before closing. Of course, this is how the trade started on Thursday. Then I removed one part just to leave one broken butterfly on. Well, sorry, it seems that I don't have access to historical data. So let me just show you the trade log. So last week, third, I started really peeling off the trade. Here I took off the 29.25, 28.50, 29.25, 29.75, then a short condor, 29.25, 29.75, 30.25, 30.50, then another short condor. It was basically scaling out to closing, and it was 30.25, 30.50, 30.75, 30.100. And then lastly, I closed the trade completely on Friday. There was only three legs to close, actually pretty easy, and I got 5 cents, more or less 5 cents for it. There seems to be a problem on the server, but that's the trade was actually very easy to close, and I always suggest or even recommend, unless you want to close the trade in one go very swiftly, if you want to close the trade gradually like I'm used to do, then you would always keep your Greeks in check so that the balance of your Greeks is not unsettled along the process. Okay, that's it for now, and I'll see you a bit later on Slack. Bye.